Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 80. This one is titled Using the VIX to Achieve Higher Option Selling Returns. We're going to use a real life example with Boyd Gaming Corp, which trades on the New York Stock Exchange under the ticker symbol BYD. Let's start off by defining the term VIX, or the CBOE Volatility Index. This will reflect the market's expectation of the upcoming market's volatility over the next 30 days. And that's based on the option premiums in the marketplace. So it's forward-looking, it's not historically or backward-looking. And it measures market risk. It's also known as the investor fear gauge. Now, option sellers, when they look at the VIX, are faced with a dilemma. And the reason is that as market volatility increases, option premiums will increase. And that's because the time value component of our option premiums are directly related to the implied volatility of the underlying securities. The more volatile, the higher the premium, simple as that. But also, the higher the volatility, the increased risk we have to the downside, as share value is more likely to decline significantly when volatility is higher. So VIX mirrors the degree of anticipated price movement, but it really doesn't give direction. So a high volatility can mean stocks are going up exponentially, or it could be going down significantly. And that's where the dilemma rises. More premium versus greater risk. So, is VIX a positive or a negative? Let's take a look back at the crash of 2008. If we were to look at a chart, some of you are listening to and watching this podcast, but I'll be descriptive to those of you who are just listening. If we looked at a chart of the VIX in 2008, we would see that the VIX quadrupled in value from about 20 up to about 80. That's huge. That almost never happens. But that was the impact of the crash. The volatility in the market just went crazy. Now, market volatility, or VIX, is inversely related to stock or market performance. So we would expect the chart of the S&P 500 to be dramatic in the negative direction, and it certainly was, as the S&P 500 declined almost 50% at some point in time over the year 2008. So as a general rule, the VIX and the performance of the overall market are inversely related. So once again, that shows you the good news and the bad news about a VIX. So let's now take this into the world of covered call writing, and we'll even talk a little bit about selling puts. Now, as you know, covered call writing is a conservative strategy, and it's geared to investors who have capital preservation in mind. We want to generate cash flow, and yet we want to be cautious with our cash. So those are two goals that I align with and have been doing so for more than 2 decades. In my opinion, the VIX is no friend of option sellers who embrace these conservative strategies. But we can use our common sense principles to manage these situations. Now, a low VIX, which I would define as being under 20, is generally a positive for us. It means market stability, and it will also show us that as the VIX goes down after a crash like 2008, the market will have a tendency to go up. So I like to see a declining or a low VIX, and especially if it's consolidating under 20. Now, what if we have a high VIX? Can we manage that? Oh, yes, absolutely. We can stay in the game by selling in the money call strikes, which will give us the additional protection of the intrinsic value component of those option premiums, and deeper out of the money put strikes, which will give us greater downside protection. Yes, it will give us lower premiums, excuse me, but we will get that additional downside protection. We can also lower our initial time value return goal range. Now, generally in normal market conditions, I like 2 to 4%. That's where I align. You may be higher or lower depending on your personal risk tolerance. But what I do in times of high VIX is I will lower that to 1 to 3%, taking down the volatility of the securities that I'm using. You could also put protective puts on your covered call trades. That's known as a collar trade. That's another way of protecting to the downside when there's high market volatility. We can also sell out of the money or even deep out of the money cash secured puts to enter a covered call trade. So we have an additional layer of protection before we purchase the securities. In the BCI methodology, that's known as the PCP, or put call put strategy. What about a low VIX? Well, if the VIX is inversely related to the market, that's a positive. It's a bullish signal. What we would do then is sell at the money and especially out of the money call strikes. If we were doing put selling, we would sell strikes closer to at the money because it's a bullish situation, less likelihood of exercise. In strong bull markets, we could set our initial time value return goal range from 2 to 4% all the way up to 6%. That's how I do it. That doesn't mean that's how you should do it, but it's an example of one way of crafting to the strategy to what's going on in the market today, right at this moment. If we were to look at an option chain of Boyd, BYD, at the time that I'm making this video, it was trading at 29.86 at that point in time. And if we were going to look at the call option chain, in a market with high VIX, we would tend to go to an in-the-money strike. In the case of the 28 strike, that generated a bid price of 255. That's still a very, very high return. Now, if we were in a low VIX environment, we would look for an out-of-the-money strike, perhaps the 31 strike, which generated a return of 85 cents with a lot of upside potential. So you would get nearly a 3% initial time value return with upside potential of an additional over a dollar. So that's how you would look at the calls. Now on the put side, we would go for a high VIX. We would want additional protection. We would go deeper out of the money, perhaps the 28 strike, which generated a bid price of 55 cents. So that would give us about a 2% return on our money, but a lot of protection all the way from 29.86 down to 28. So there's a lot of downside protection there. Now we would go in a low VIX environment where we have a little more security regarding enhanced share appreciation. We would then maybe consider the near the money 30 strike, which generated $1.25. So we get a very, very good initial time value return with the likelihood of share price accelerating, thereby leaving the strike out of the money at expiration. So we can, again, craft these strategies to what's going on today, right now, at this second. So that's how you would use the strike selection relating to the VIX. So let's summarize, folks. The VIX is a factor that should be considered in our option selling decisions. When I create our premium member reports, I always talk about the VIX. I give you the current VIX, and I let you know whether or not it represents a bullish or bearish signal. Now, the VIX should neither be feared nor embraced, but rather managed using fundamental, technical, and common sense principles. And that includes strike selection, security selection, and initial time value return goal range. We could use these factors to craft how we're using our option selling strategies at every given moment. And if we're doing monthlies, we could reassess our bullish assumptions or bearish assumptions on a regular basis, weeklies even more so. So keep in mind that we could use option sellings in almost all market environments, and the VIX is an important factor to look at. Before I go, let me remind you that we have a lot of free resources on the bluecollarinvestor.com website, including calculators, files, and much more. We have the Beginner's Corner tutorials for covered call writing and selling cash secured puts. So visit our website for that, and www.thebluecollarinvestor.com/store for our books, calculators, spreadsheets, online mentoring programs, trade planners, video programs, and so much more that will help us master these option selling strategies and assist us in beating the market on a consistent basis. Folks, thank you very, very much for taking the time to listen to, and in some cases, watch this BCI podcast number 80, using the VIX to achieve higher option selling returns. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.